Okay, my fifth proof is using derivatives to manage money is too costly, too risky, and a waste of money. Okay, well this is my favorite section because I get to talk about what we do. And of course, Sherlock Holmes is not a real person, but I love his quote. And of course, the author, Ian Anderson, wrote the quote, when you eliminate the impossible, no matter how improbable, must lie the truth. And so let's kind of go into the truth. Is it possible to get market returns without market risk? Really? Seriously? Sell me a bridge in New York, baby, right? Can we do this? Who says this is true? Who says this is false? Can I get a raise of hands? Who says this is false? Can I get market returns without market risk? Okay. Okay, and then you guys are sitting there going, okay, what's the catch on this one? You're ready for me. Okay, of course it's false. I can't get market returns without market risk. Come on! It's impossible. Okay, let's talk about structured investing. It's one of the things that we do for financial advisors, for pensions and endowments. It's not magic, it's just mathematics. So let's kind of go through it. I'm going to give you a case study. Case study is actually from one of my ex-interns. He called me, ex-intern actually came in my office and said, Dom, my aunt, that's his aunt, Julie, is getting divorced. And my aunt, is just got married. Her husband married her because of her brilliant mind, of course. And she's 40 years old, lives in Hawaii. She lives in Hawaii. Okay, here's a woman that, she got $2 million in the divorce, and she's got like $200,000 for the next 5 years. But she said, she called me up. Here's why she called me up. She wanted no market risk. She wanted safety, 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 safety. And she had a Merrill Lynch broker. But Merrill Lynch broker, after hearing that she wanted safety, 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 he did what? He put her in just diversified bonds, right? Debt. He just put her in debt, and he said, okay, well, you have default risk, but you don't have any market or systematic risk. She's just scared of the market. But she's making a yield to maturity of 4%. And she said, I'm not going to get there. I've got to, get my PhD, building my mind, my hair done, my nails done, my sailboats, whatever. So here's a woman that lives, $2 million is not enough at 40, and she realizes that she needs at least 10 million. So she needs market returns without market risk. So she said, my nephew who is interning with you says, I can help you. You can help me. And I said, yeah, okay. I said, send me all your statements. So my team did the analysis, and we calculated a YTM of about 4%. Now, YTM is a very spurious, and I'm not going to go into the problems with yield to maturity, but just let's say 4% is the discount rate that we're going to use. She needs more money, and she doesn't want any more risk. So what are we going to do? We're going to use something called an exchange-traded derivative. So here's what we're going to do. $2 million at 4% interest, it generates $80,000 a year. So what can she do with the interest generated? Well, what we did was we went to our software and we said, okay, let's take a look at what a one-year call option is going to cost. And a one-year call option, if you can't see the screen, is going to cost just about $965 a contract for a one-year option on the S&P 500, the SPY, yeah. We use the ETF, the SPY. Okay. So we said, okay, for $80,000, how many contracts can we buy? We can buy 82.9 if we had to round down to 82 contracts. Can't buy 0.9. Right, Pat? Did we fix that problem with the calculator? Can't buy. With our calculator, it had fractional contracts in it today. I didn't understand where that came from. But anyway, we calculated the participation rate in the market, and that came to 71% participation. Now, how does this compare to a traditional 60-40 asset allocation mix? What does that mean? 60% stock, 40% bond. This is the most popular mix in financial money management. Why? Because Dr. Sharp and Dr. Markowitz, back in the 50s, only had 10 years of data, and they looked at what the optimal mix is, going back 10 years, and they said the best mix is a 60-40 stock bond mix. So this is actually the most popular mix. If you walked into most pensions, if you walked into most professional money management firms. Guess what? And you added up all the different equity positions, and it might be international equity, U.S. equity, emerging markets equity, and you added up all the different types of debt. It might be emerging market debt and municipal debt and corporate debt and sovereign debt. It's going to be about 60-40. It is the most popular. Just look at a typical statement. It's going to be about 60-40. With age, it's going to change a bit. The Financial Planning Association said the amount of money in your portfolio should match your age when it comes to your debt position. So if you're 40, if you're 80, you should have 80% of your money in debt. If you're 40, you should have 40% of your money in debt. Okay, so therefore you're going to dampen that mix. Okay, so we're all with me on that. So let's look at the most popular mix. How does a 71% participation? Because I'm selling her a call, which is going to go up with the market, and she's invested in bonds. So if the call expires worthless, she still has her bonds full value, and she's going to just generate another 80,000. So how does this 71% compare? Well, actually, the beta, the upside beta on a 60-40 mix is about 44%. So that means that a 71% participation is about having 90% to 80% to 90% of your money in the stock market. So I told Julie, I said, Julie, I could give you 71% of what the S&P does on a yearly basis with no more risk than you currently have. No more risk. She goes, well, that's impossible. I said, I'm going to use a derivative. I'm going to use an exchange-traded call option that's traded on the exchange. She said, well, okay, that's kind of interesting. So what did I do? I increased the return potential with no more risk. But what's the negative? What's the downside of that? What is she giving up? What is she giving up? Who can tell me what she's giving up? What's that?
Death.
Well, she's giving up death? No, hopefully she won't die. A death. She's giving up the interest. She's giving up, if the market should crash, then she's going to make zero. And she could have kept that 4%, right? Is everybody with me on that? So she's giving up the opportunity to make 4%. But here's the interesting thing. We only bought 1-year options, and we were going to buy 1-year options every year. So that means if the market went down year one, and then she had to rebuy those options in year two, she would be buying them at a lower market. Markets don't go down. You know, I think the longest the market's ever gone down is 3 years, and I think that was 29 to 32. So the idea is she can reset her position, and if the market just went sideways, she'd actually make a return that's far better than 4%. So really, what did we do? We gave her market returns with no more risk than she currently had. Now, I got a question for everybody in this room. Did she do this? Does this make sense? Does this achieve her goal? Does this achieve her goal? Sure. Is she getting market returns with no more risk? Yes or no?
Yes.
Okay, sure. Thank you. Okay. Now, the second question is, did she do this? No. She went to a Merrill Lynch broker, and what did he say? He's going to put you in options? He's going to put you in derivatives? And you want less risk? Okay, that's true. The financial community understands about this much when it comes to derivatives. Half of my job is trying to educate financial advisors. Okay, so let's talk about some of the structures that we build for our clients. Here's a volatility structure. Which way the market goes, we make money. And if the market doesn't move, then the client doesn't lose any money. Okay, we like this guy. Okay, here's another structure. Again, 80% of the upside of the market with no downside risk. Short term, this is a 2-year note tied to the S&P 500. Okay, no downside risk. Here's a buffered note. Buffered note means that you're buffered. In this case, we're buffered on this particular position. And you're getting 125% of the upside with a 20% buffer. So let's assume the market goes down 22. My client will be down 2. But if the market went up 22, my client would get 125% of 22. So not only am I giving my client a better return than just 100% in the market, but I'm also giving them a downside buffer. Ladies and gentlemen, why doesn't everybody do this? Why would you buy the S&P 500 when I can give you that? Well, there is an answer. Anybody?
Because we don't understand it?
Well, that's one answer. Well, what am I doing here? What am I doing? I'm actually not, I'm eliminating market risk, but I'm trading market risk for another type of risk. What kind of risk? Does anybody have an idea what kind of risk? Pat, what kind of risk am I transferring? What's a risk transference? Default risk. Okay, now what do we know from modern portfolio theory? Dr. Markowitz and Dr. Sharp said you can't diversify systematic risk because of exactly what they found out, that correlation coefficients go to 1. But you can diversify default risk, can't you? If I have a basket of corporations consisting of Burger King and Kroger and Rite Aid and Tesla, if I have a basket of 100 bonds, $1,000 a bond, has that diversified mitigated my risk? Sure it has, because you're not going to have a systematic event across that. I shouldn't say that because that's what Bernanke said about mortgages, but that is one sector. And then there's another way I could diversify default risk. I could shorten duration, couldn't I? Because if I have a 20-year Burger King bond, and by the way, I think the Whopper's way better than the Big Mac, okay? And I think it's better than the Smash Burger, Pat, okay? But the bottom line is, think about what I'm saying here, ladies and gentlemen. If I have a 20-year Burger King bond, if I had an 80-year-old client, and he came in my office, and he says, I want to put my money in something safe. I said, I want to put you in a 20-year Burger King bond. Would that be prudent of me? Would that be smart? What do you think? No, I could get sued. That's malpractice. But there's a couple things I could do. I could say, well, I could put you in 100 bonds, $1,000 a bond. Would that be a better thing to do with an 80-year-old and diversifying that? Problem is, now maybe he's making 3 or 4%. But I also could do this. I can also shorten duration, couldn't I? I could say, listen, I'm going to put you in a 1-year duration bond. I remember in 2009, I couldn't buy these bonds quick enough. I was calling up my trading desk, buying millions of dollars worth of, believe it or not, American Express 6-month maturing bonds were yielding 18%. 6 months, American Express, 18% yield to maturity. I'm like, load up the truck. How many of those can you get me? Citibank was trading at 59 cents. You know, the bottom line is that diversification is what we're doing. We're basically using the debt and the discount rate from the debt to invest in those derivatives. So we're getting market return and we're diversifying our debt. So we really have a better mousetrap than just buying $1 million of the SPY or the SPX. Here's one where we're saying, hey, I'm going to give you a much more buffered note, 45% on the downside with 100% of the upside. Well, here's what's interesting. On this note here, we have 125% of the upside. So what I can do is I can give you more protection on the downside, and I'll have to deleverage on the upside. But you know what? If the client's down 49% on the S&P or 50%, he's only going to be down 5%. But if he's up 50%, he's up 50%. To me, these are no-brainers. These are no-brainer investments. Here's another one, a fixed income note. A lot of endowments like this. They need to make a 6% return. As long as the market doesn't move more than 1 standard deviation in a year, the client's going to make a 6% return. Okay, and if the market does move than more 1 standard deviation, the client is going to make 0. So there's no risk. We're just looking to guarantee an income, like those pensions like. Those pensions like. You know what's nice about structured notes is we can do it with everything. We can do it with Apple. We can do it with gold. We can do it with emerging markets. How cool would it be to build structured notes in a diversified portfolio within that model, a global portfolio? So maybe emerging markets has a good year and U.S. doesn't. Maybe Israel market has a good year 1 year. So I could diversify within a structured situation. Isn't that a better way to run money? I think it is. Okay, so is it possible? I think it is possible. I think it is possible. Okay, great accomplishments are not achieved by extraordinary men doing extraordinary things, but by ordinary men doing ordinary things extraordinarily well. John F. Kennedy said that. And that's really what we try to do at our firm. So let's talk about how we can improve upon modern portfolio theory.